Hello again, everyone, and welcome back to our market report. As always, I'm Dion Zakuski, Branch Manager and Director of Wealth Management here at Scotia Wealth in Central Alberta. And it's now September, and after Labor Day, this means many things to many people. For lots of us, it's back to work, back to school, and in general, back to life, which includes your finances. But don't worry, your Zook group has been hard at work over the summer, and today, in our market video, we're going to check out three things. One, a summer recap, what happened in July and August. Second is recession talk. What's all this mean and how should we respond to it? And lastly, given all this information, what should we do next as investors? In looking back at the market action over the summer, it was really a tale of two stories, which can be broken down easily into the months of July and August. After a sizzling first half of 2019, markets paused briefly in the first part of July, but as the month progressed, more and more positives emerged. We saw improved trade talks between the US and China, surprisingly good earnings reports from some of the largest companies in the world, and an interest rate cut. All of this together helped to fuel markets to move higher. But August wasn't quite as rosy. Trade progress seemed to unravel, and concerns over slowing global growth caused money to flow into more safe havens such as bonds and out of the stock market. This caused a unique situation in the bond market called a yield curve inversion. More on this in a few minutes. But basically, it spooked markets thinking a recession might come. Of course, being summer and the lack of business news, the media jumped all over this, and it produced some really big daily swings in the market. I mean, these swings were more erratic than my golf driver, which if you've golfed with me, you know can be pretty out there. But when we put it all together, basically the summer performance was actually quite flat. The US market was down just a little bit, and our Canadian TSX actually finished up a hair. Switching to this recession talk, as I mentioned a moment ago, part of the current market volatility has to do with a recession indicator called an inverted yield curve. But before I get to that, we need to look at a couple key concepts. First, despite what the business news would like to sell you, a recession does not equal a market crash. Okay, it can equal a market slowdown, but not a crash. A recession is actually a normal part of the economic cycle where you have expansion and growth, plateau, and contraction. Contraction for 2 quarters in a row in an economy is then called a recession. Okay, but what about this inverted yield curve? Okay, so to keep it simple, a yield curve is simply a measure of an expected rate of return for bonds or fixed income at different maturity dates. If you own a longer term bond or GIC, you should be getting paid more than a shorter term one. However, due to certain economic factors at times, there may be more demand for longer term, especially government bonds, for safety, and this can cause their prices to increase. If their prices increase so much, that actually brings down the value of that bond, where what can happen is a shorter term one may be worth more than a longer term in a certain period of time. This is called a yield curve inversion. Now, why this is important is because it can be an indicator of an upcoming slowdown or recession. But it's not a good predictor of when that may happen. The last time we actually saw this, prior to the August, was in May of 2007. And we're going to show you a bit of history here in a chart that goes into it a little bit further. We're taking some information from the US, which is Canada's biggest trading partner, and basically follows a similar type of economy. And our information in this chart goes back to January of 1948. The gray pieces are actually actual US recessions. And if you look at the blue line, whenever it crosses down across the horizontal black line, that means that yield curve is then inverted. So looking back, we can see that even when this indicator happens, on average, it can take around 15 months before we actually see a real recession or economic slowdown. However, as investors, what we need to know is, when will the market slow down? And we're going to show you another table here that goes into it a little bit further. Looking at a yield curve inversion of a 10-year versus a very, very short term of 3 months, we can look across at December 1978, May 1989, September 1998, and even February of 06 when that inversion happened. And for the market to actually slow down, it takes anywhere from 14 months up to 23 months, almost 2 years, before the market will actually turn over. So, with all this information, at the end of the day, is this a big concern? Keeping in mind, this is a normal part of the economic cycle. It actually shows that market history predicts that there could still be gains to be made. Our job, of course, is to continue to monitor these many indicators to look at when to pull back on equities and switch into other asset classes. Which brings us to our next point, what to do next. Armed with all this incredible economic knowledge, we need to know how to position ourselves. And as we just showed a minute ago, although there's a few yellow lights out there in the economy, market gains are not only still possible, but still likely to happen. That's because for now, most fundamentals out there remain quite stable. And we're looking at areas of the labor market, the services sector, consumer and government spending. All are still in pretty good shape. However, the fall season can be tricky though, and we do expect some turbulence over the next few months. There's ongoing global trade talks, we have a federal election here in Canada, and there will likely be some interest rate movements as well. But when we mix all this together, our team still believes that staying the course is the right move. We're going to continue to also reduce risk by holding investments in other areas, which include bonds, real estate, infrastructure, and so on. But with that, we'll sign off for now. There's always more information at our website at zookgroup.com. And if you have questions about your specific strategy, then just contact us anytime. Thanks for watching. See you soon.